the market's in a total freefall, right? Everyone is selling, everything's red. How on earth can that possibly be a good thing? Well, today we're going to break down value trading, a strategy that sees a massive opportunity where most people, well, they just see pure panic.
Okay, just picture this for a second. You wake up, you check your portfolio, and a stock you've been watching is down 25%. Just like that, instantly.
And why? Well, some bad news just hit the wire and the market is panicking. The stock is absolutely plummeting. Now, for most people, this is a code red, 5-alarm fire. It's a clear signal to sell, get out before it gets any worse. But for a certain type of investor, this isn't a disaster at all. For them, it's an opportunity. And this is exactly where the value trader thrives. They look at that very same plummeting stock and they see something completely different. Pure, unadulterated potential.
So what exactly is value trading anyway? Honestly, you can think of it like bargain hunting, but for entire businesses. It's the art of finding a really great company that's on sale for a reason that doesn't actually hurt its long-term health. Kind of like finding a designer coat at a huge discount just because of a tiny, totally fixable tear.
And this right here, this visual, it gets to the absolute heart of the conflict. On one side, you've got the market price. That's what's driven by emotion, by scary news headlines, by panic. But the value trader, they're laser-focused on the other side of the scale, intrinsic value. That's the company's real, underlying financial health, the stuff proven by fundamentals like solid cash flow and low debt. And the core belief is simple. Eventually, the emotional price always catches up to the rational value.
Okay, so how do they actually do it? How does a value trader look at that terrifying 25% drop and confidently decide, yep, that's a bargain and not, a bankruptcy in the making? Well, it all comes down to a really clear, disciplined process.
It all starts with homework. A value trader never ever guesses. They dive deep into the financial statements to calculate what they believe the company is actually worth. Then they compare that true value to the panicked market price. And if there's a big enough gap, they buy. And then, and this is the hardest part for most, they wait.
And this is the absolute key concept, intrinsic value. You could call it the value trader's North Star. It's not some gut feeling, it's a number. And it's often calculated using models like discounted cash flow, or DCF. Think of DCF like this. If you somehow knew exactly how much money a fruit tree would make for the rest of its life, you could figure out exactly what that tree is worth today. That's what a value trader is doing, but for a whole company.
Which brings us to maybe the most important concept for survival in this game, the margin of safety. Let's say a value trader calculates a stock's intrinsic value is $100. They don't go and buy it at 95, no way. They wait for the market panic to drop the price to, say, $60 or $70. That huge discount, that's their buffer. It's their protection in case their analysis is a little bit off, or maybe the recovery just takes longer than they expect.
All right, let's get back to our story. Remember that company whose stock just plummeted 25%? Well, the value trader did their homework. They saw that margin of safety and they decided to buy. So, what happened next?
So the bad news turned out to be an unexpected supply chain issue. Now, that's a real problem, for sure. But was it a company-ending problem? The value trader, after studying the company's super strong fundamentals, bet that it wasn't. So they bought shares while the price was in the gutter. And sure enough, about 6 months later, the company sorts out its supply chain and the market's confidence, and with it, the stock price, comes roaring back.
And this, right here, is the result. By buying during that panic phase at a huge discount, the value trader was able to lock in some pretty significant gains when the price recovered to a level that was much closer to its actual intrinsic value. See, they didn't predict the future, they just correctly analyzed the present.
So, what can we all take away from this? Really, this entire approach is about shifting your perspective, moving away from the chaotic daily noise of the market and focusing on the long-term health of an actual business. Ultimately, the value trader's mindset really comes down to these core ideas. They ignore the daily headlines and instead focus on the business's fundamentals, the strong roots of the tree. They operate on this core belief that while the market can be totally irrational in the short term, it's almost always rational in the long term. And that's why patience isn't just a virtue here, it's their single most powerful tool. Because they understand that famous saying, price is what you pay, but value is what you get. And that kind of leaves us with a fascinating question to think about, doesn't it? If we apply this mindset,
What temporary problems or market overreactions that are happening right now might be masking a solid company's true, long-term worth? It's all about learning to see the value through all the noise.